you so much, Kunal. Thank you so much, Rudra, for joining us this morning. Let me bring on board Neelkanth Mishra, Chief Economist, Axis Bank, and Head of Global Research, Axis Capital. There's no better voice, viewers, at this time than Neelkanth, who kind of contextualizes everything. So, Neelkanth, let me first start off. Great having you. A long-awaited conversation, frankly. So good having you. Neelkanth, let me start off by understanding, based on whatever I heard of your views over the last 20 days to a month, you said 15th April was going to be that critical timeline. If supply chains rewire themselves and open up by 15th of April, no major impact. Otherwise, globally, we see a recession. Talk to us about what this means as of today. We're on the 21st of April.
So I think the inventories are running dry. We already have signs like, in India, the plastics market, the furniture makers are now priced out. So plastic chairs, tables, those are not being manufactured. There are projects which are stuck because critical materials are not available. There are airlines from Europe which have stopped flying to Thailand and Vietnam because they can't get refueled on those airports. So the stress has started. I think the system seems to be calibrating much more efficiently, and therefore maybe there is a couple of weeks extra of inventory. For example, if say a person in the US driving to the lake every weekend has stopped doing that at $4 or $5 a gallon, so that's fuel saved. If from slightly less efficient usage of materials or energy, things have moved out. Plus, there seems to be, I think, reasonably efficient inventory distribution so far. But I must say that I think the product inventories are now starting to hit precarious levels. So that 15th of April was a broad estimate. Maybe it is 30th of April, but it's not 30th of May. And I do think that we are now starting to hit levels where growth is already starting to get impacted.
Neelkanth, even in the global markets, oil inventories are falling fast. Do you think the oil prices will now be in the same range for an extended time as compared to earlier, what the thinking was?
If you, the best measure of this is what is the oil price average over the next 12 months? Because see the next month's price, and frankly, see this is where the difference between dated Brent and next month's contract, there is a wide divergence. Dated Brent means that if you want actual physical inventory today, at what price do you get it versus getting it next month? Because everyone is assuming that the opening of the Strait of Hormuz is only days away. Now, if so the next 12-month average price versus say January was I think $59. On the day that the ceasefire was announced, it was about 74, 75. I think it is still broadly in that range. So there is a $15 average increase that has happened. For the 12-month out or the 9-month out price, those prices are still $7, $8 higher. So clearly, I don't think there will be complete normalization very quickly. I think inventory buildup will happen. People will focus on resilience a lot more, and therefore demand goes up by that much more. You saw Kuwait now announcing a force majeure. So basically, these countries are now filling up their oil reserves and therefore being forced to cap oil wells. So those concerns mean that the longer this lasts, the longer it takes to normalize energy markets.
Assuming that the peace talks go through today and tomorrow, and the Strait of Hormuz opens, the anticipation is that there may be a passage fee that may come into play, not only for Iran but also the Gulf countries. Is that going to increase the cost further for oil and gas from that region?
I don't think it's going to be a meaningful one. So even if you take that $2 million per ship fee, that $2 million per ship fee was for 300,000 ton tanker, which means about 2.1 million barrels. And so that's like $1 per barrel. So $1 per barrel, even $2 a barrel is, while I think it can be meaningful for, say, Iran in order to rebuild all the damage that has happened, it may not be a very big burden for the world as a whole. So, adjusted for everything, there could be there was a 21 million barrel, 20.9 million barrel a day transiting through the Strait of Hormuz before the war. Maybe post the war, it could be 12 million barrels a day. And so if you just do the maths, it's $8-10 billion a year. So I don't think it's that charge by itself will be a meaningful cost. I think the bigger issue is the normalization of the supply chains. More importantly, and I think everyone is obsessed with the availability of crude. What people are perhaps forgetting is the availability of products, meaning refined products. So quite a bit of global refining capacity was in the Gulf Cooperation Council. And while of the 8.2 billion barrels of oil and product inventory that we entered the war with as a world, about 5.6 billion was crude. And so the product inventory was lower. And I think that's where, I heard from someone that bunker fuel, that is ship fuel, where Singapore is the fueling station of the world, that may start running dry in the next 2-3 weeks. And clearly airline turbine fuel is, ATF is definitely going to be in shortage. It's already starting to show up. So there will be products where I think the challenges will be a lot more severe. And so getting those refineries started, how much of the refinery capacity is damaged, I think those are the big uncertainties, not just the transit cost.
So Neelkanth, so far, resolution or not, should India brace ourselves or be structurally sort of exposed to a higher oil bill? Is that the new reality that, or assumption that one needs to work with?
I don't think so. My assessment of this conflict, see, there are 4 grades of conflict. There is a grand war, there is a war, there is a campaign, and there is a battle. What is happening in Iran is somewhere between a battle and a campaign, most likely still a battle. The grand war is between US and China. Grand wars are generally about competition between economic models, about political systems, and access to energy and the price of energy. Because you can't grow an economy, you can't be strong till you have abundant energy and cheap energy. The difference between the US and China is that the US 72% comes from gas and oil. The power grid has not seen investment for, I think, maybe several decades, maybe 50 years. And you must have seen the state of Maine has now banned data centers from being created. There's some 10, 12 cities, urban governments, which have put a hiatus on data centers in their territory. So the US is going to be much more dependent on oil and gas for its energy levels. And for it to become efficient and compete with China, it needs to keep oil and gas prices low. So it is a vulnerability for India. I think that vulnerability has been exposed. It is very important for us that we address that strategically. It is very important that we electrify a lot more than we have done. So about 15% of our energy is consumed in the form of electricity. In Japan, it is 32, and China was at 15% like 20 years back. So they're now at 25, 27%. So we need to electrify a lot more. We need to reform our power distribution. There are some remarkable things happening. I don't know if you saw, Google got a Discom license in Andhra Pradesh about a week back. These are transformative things that are starting to happen. So we need to work on the strategic mix of our energy. But at the same time, I am of the view that the vulnerability that we have on oil and gas and the import dependency is not going to be tested for beyond, say, 6 or 9 months.
Relieved to hear that. Have to ask you about what you made of the core sector data, the first decline in 5 months. I mean, how alarmed should one be?
See, some of those could, be maybe even backward looking. See, I think some of the measures in India are looking very strong. So what we have is very strong cement volumes. We have very strong auto volumes. So we have very strong credit demand. So by and large, the economy is actually holding up well. And there are, I think, sector-specific issues like, say, oil production falls by 5-6%. We also, I think, in the first few weeks of the conflict, I mean, there were maybe technical issues which prevented, say, getting enough LPG or getting enough fuel or crude oil. But I think those are getting sorted out. So from what we gather, by in the next couple of weeks, the inflow of crude into India is actually likely to pick up. So there may have been one-offs in March. It was concerning to see that decline. But by and large, at least till so far, the economy is holding up much better than was feared.
Now, Neelkanth, when I'm looking at how you're kind of assessing how India is likely to do, you seem to be a lot more constructive with regard to India. But globally, that 3% growth that has been penciled in broadly as a consensus, you don't seem to be of the view that we will likely clock that, just given the fact that this is already kind of prolonged, right? And therefore, you might see an impact on demand globally. But talk to us from an India standpoint, therefore. What are the top sectors you would completely avoid at this point, or where would the impact be seen in the most pronounced fashion?
See, first is that there is a 3-4 month growth impact that even India will see. See, it is holding up better than was expected, but of course there is going to be an impact. I mean, the very fact that the plastics that are available, or some chemicals that are available, which are now available at 50% higher prices, people are cutting down on that consumption, which means that some kind of production is getting hurt. We have seen, I mean, the most popular one that the tiles production in Morbi getting impacted, and that having downstream effects. So I think there will be a growth impact. I think the first quarter may be slower, and depends on how quickly we restart, but it's going to be definitely slower than we had earlier expected. For the world as a whole, I think there are three ways in which the impact happens. First is the physical access to energy. So far, because of inventories, that physical access has not been that badly affected. But in some of the products, we are weeks away from people actually running out of stuff. The second is the transfer price. So at $105, $110 per barrel, because the Brent may be at 95, but dated Brent is actually much more expensive. So on a fully price basis, the oil market could actually be $1 to $1.5 trillion higher or larger than it was pre-war. So lower volumes, but much higher prices, which means that the buyers are paying $1 to $1.5 trillion more. So the buyers have less money to spend on other things, goods and services. The sellers would see this as windfall gains, and therefore are not going to spend it. And so then the money gets locked. And that's another channel for growth impact. And the third impact is the supply chain disruption. So, access to methanol and sulfur. I think some of those things are starting to show up. There could be countries in South Asia, Sri Lanka, Pakistan. There could be East Africa. There are some countries in Southeast Asia which also are vulnerable to some of the early disruptions. When it comes to the markets, I think that it's still fairly a binary call. If the energy disruptions, the Strait of Hormuz does open up, as President Trump is promising to in the next couple of days, then I would say that we are mostly back to where we were before the war, with the change that the energy mix, the priorities will change. I think power sector looks much more attractive than it was. We have credit growth. I think that's actually remaining quite strong. And I hope that some of the liquidity issues that were plaguing us will start to get addressed. I think the real estate market still looks quite attractive. So those are the sectors that you would remain quite constructive on.
And Neelkanth, what should the best case and worst case impact be on India earnings FY27? What are you penciling in?
Look, as much as we hate uncertainty, as you know, our brains are always optimized for reducing energy consumption, and that requires that you work with certainty. Handling a lot of uncertainty is very energy intensive. So it is very tempting to seek clarity. Sometimes it is wiser to let uncertainty remain in our brains. That see, the sensitivities are very clear. If oil prices average $100 a barrel over a year, the growth impact is about 2%. Inflation impact would be about 125, 130 basis points. It's a step jump, does not need monetary policy action. And there would be a currency depreciation that will be necessitated by the balance of payments problems. But again, a lot depends on whether in the brinkmanship that plays out, while it's now reasonably clear that the kinetic phase of the war is behind us, but you never know. I mean, the Marines and the airborne divisions are all there to threaten. And what if it escalates? In which case, then the worst case is really bad. But I would say that we were at 7.5% growth for FY27. It's very likely that we see at least if say things are opening this week, maybe a 30-40 basis point cut in that growth rate just because of this event. We will see as the year plays out.
Neelkanth, how do you look at the core sector numbers which came in yesterday? Fertilizer production down nearly 24%. We're facing increased cost of fertilizer also if you are importing it. Do you see that impacting some way other sectors as a second order impact coming in through as well?
Look, on the availability side, clearly the government's tactic, from what I read in the papers, seems to be very clear that we will not let availability be a problem. So newspapers are reporting that government firms are bidding aggressively and getting all the volumes. So the fact that urea prices have almost doubled is not preventing us from buying more urea. If it lasts a year, we are talking about maybe 1.5 trillion rupees of extra fiscal spending. The subsidies on LPG, the fact that prices have not been taken up, or the subsidies on implicit subsidies on the transport fuels, these I think will slowly, if the prices do remain high, and not just crude oil but also refined products, it is possible that we start seeing price increases. So by itself, it's as of now a fiscal cost, meaning that there has to be, you're getting it at the same price, at a higher price, but volumes remain somewhat intact. If this lasts beyond maybe middle of May, then we are talking about maybe physical shortages because domestic production may not be sufficient, as you said, rightly. In which case there could be, second order effects. But frankly, even doing those sensitivities requires as to the level of disruption, because the way the US leadership tends to negotiate, it is never about a stasis. It is usually to break the stasis, to escalate. So it may be tempting, as I was responding to Harsh's question earlier, to seek certainty, but it is sometimes better to, remain uncertain and remain unclear, because the paths are too divergent going forward. Because in the process of forcing a deal, if the issue is escalated and the power the systems are really hurt in China, in Iran, and in Iran in retaliation starts hurting energy infrastructure in the rest of GCC, then we're very, very badly affected. So anyway, I think at this stage, it's better not to answer that question.
Okay, ignorance is bliss sometimes. But Neelkanth, on the currency, have to talk about that, because so much of its linkage is with capital flows as well. You've recently talked about the fact that the pressure on the INR is unjustified, given the CAD position, yet the INR continues to be weak. A, what can be done? Or do you think this is more of a capital flow overriding story than more a domestic structural story playing out?
Exactly. So, look, the real effective exchange rate has fallen by about 12% from its recent highs. It was perhaps too high. The real effective exchange rate is generally not a very good predictor of near-term shifts in currency. But with the 12% decline, I think it is prudent to allow the economy to adjust around it. For example, if the rupee has weakened so much, at the margin, someone who thought that Vietnam is cheaper than going to Goa will actually not fly out and maybe take a domestic vacation. There will be different products and services, goods and services, where import substitution or an export jump can be possible, but that requires 3 to 6 months of stability. So I don't think the rupee necessarily needs to weaken meaningfully right now. Of course, if oil prices stabilize at $100, which I think is a much bigger problem for the world than it is only for India, then maybe the rupee needs to weaken. But it's too early to make that call. What had happened, and this was what necessitated some of the interventions, the policy interventions that we saw towards the end of March, was that the process of internationalization of the currency had opened up a pipe between the offshore markets and the onshore currency markets. And it was becoming too large a pipe. Basically, too much or too many of dollars were actually leaking out. And it is still unclear as to how much of that offshore activity was fundamental, how much was speculative. But I would say that my guess is that quite a bit was speculative. So now that has been curtailed, I think there is some room for the RBI to be able to control the volatility in the currency. But if the dated Brent remains at 130, 140, and this thing lasts for another couple of months, then the rupee perhaps needs to weaken again. There is a terms of trade shock. It would be unwise not to let it play through.
Makes sense. Neelkanth, such a pleasure having you on the show today. Thank you so much for your time. Great insight.
Thank you. Thank you for having me.